And so on the income side for industrial, we actually have quite a strong view that the rental growth in industrial could go straight back to average, which is about 3% per annum from this year. And that's because the occupancy side really is so tight. There's been so little construction over the last couple of years. And interestingly, if you look around the world, there's been so little construction activity across all the commercial sectors that a similar forecast is often proposed in markets around the world. It seems counterintuitive to be moving back to sort of average rates of rental growth so quickly, but it is because the supply side is so tight in Melbourne and indeed in many parts of the world. Let's turn our focus now to the retail sector. Of course, it's been in the headlines for a few years now. A lot of issues are all revolving around the performance of the retail industry as well as the retail property sector. We think part of the story around retail is that the period around 2002 to 2006 was a period when retail turnover, the key driver of the sector, was very high, and it was also a time when a lot of retailers entered the market assuming that those levels of growth were normal. And many other retailers, of course, were expanding at that time. Now, the retail turnover has dropped, and it's dropped below the long-term average, which is around about 4% or a little bit below 4%. And the forecasts assume that we won't be getting back to that 4% growth for maybe even 3 to 5 years. So it's going to be, we think, a long recovery, a long, very gradual recovery for retail and the retail drivers, unlike perhaps office and industrial. But we've been impressed in a way that the retail sector has actually been quite resilient. We did a back-of-an-envelope calculation last year looking at retailers that had gone into administration. We counted up maybe 300,000 square metres of floor space that had been vacated through business failures. Now, that's a lot of floor space, but it represents less than 2% of the total retail stock in Australia. And much of that space has already been re-let. So we've been actually quite surprised by the amount of new entrants into the market who've been happy to come in and soak up that vacant space. And this chart shows you the vacancy in some of the submarkets that we monitor here in Melbourne. And you can see that still vacancy rates are around that sort of 2 to 4% range generally. But in retail, you do find these sort of outliers occasionally. So you find places like Bridge Road where there's been high exposure to fashion, and that's led to a much higher vacancy rate than you would generally see. And I think that's really the story of retail too. When you look into the property sector and in the downturn, you see spots of problems, but you don't see widespread problems in the retail sector. It hasn't been enough to really drop the overall average of rentals and to cause a blowing out of yields overall. So there's only been these sort of occasional spots of concern. So what it means to us is that our forecasts really haven't changed that much. We've stuck with a long-term sort of incremental increase in retail rentals across most of the major submarkets of the retail sector. And, you know, I think it's important to remember too that there's been a lot of distortions in the marketplace over the last few years, and you know, this federal stimulus package was fantastically successful. There's particularly the boost package that led to an increase in dwelling approvals, which of course leads to demand for household goods and demand in the retail sector. And this chart shows you for Victoria just how successful that stimulus package was in lifting building approvals. But unfortunately, we're still actually coming down off those highs of building approvals, but we've seen a 30% drop in house and apartment approvals over the last couple of years. And so we're still really recovering from this, and the distortions in the marketplace need to be removed before we start to get back to some kind of normality, or at least we can get a chance to move toward normality in the retail sector. So look, overall we think that the Melbourne market will hit an economic and sort of employment growth bottom in 2012, but the national divide is definitely widening through this year. One of the key factors in our forecast is that the cap rate compression side of the equation for value adding will be very mild in this cycle due to the high cost of debt. In Melbourne and indeed across the country, we think the office is still the choice sector for generating income growth and rental growth. The concerns over Europe will be continue to be a key handbrake on confidence in in Melbourne particularly. And New South Wales is getting organised, that's right. I think there'll be a bit more competition between those non-resources states emerging in the next 1 to 3 years. So look, I hope that gives you a wrap-up of where the Melbourne situation is and where we see it. It's certainly a tough year ahead, but the fundamentals are still in pretty good shape. So now we're going to move to something new in the Melbourne Market Outlook's long and illustrious history. We're going to conduct our panel discussion with our local professionals. So I'd please like to ask the guys to come up.
Please welcome Senior Director, Institutional Investment Properties, Mark Costa. Director, Retail, Valuation and Advisory Services, Stephen Thomas. Senior Director, Hotels, Scott Callow. Senior Director, Industrial and Logistics Services, Dean Hunt. Director, Metropolitan Investment Properties, Justin Clarkson. Senior Director, Office Services, Chaz Keogh. And Director, Residential Projects, Andrew Leoncelli.
Okay, welcome guys. Let's get the conversation started. Let's start with you, Mark Costa, right here. Mark, of course, works in our CBD office investments area, an important part of the business, a big part of the business. Now, Mark, we've seen the rent growth potential in Melbourne in 2011 not quite meet the target that we thought, and the forecasts are reduced somewhat as well. What impact do you think this change will have on investor sentiment toward Melbourne?
You know, I think we saw sort of Melbourne, I guess, not quite hit the benchmarks of where most people thought growth would be for income, especially last year. But what we are seeing going forward is maybe a tempering of that growth, not a complete falling off of that growth. And it's sort of been discussed with some of the things that you've been talking about, Kevin, and earlier with Nick, that we're going to see a nice, consistent level of growth, you know, not even in the short term, but right through the sort of the next 10 years. So what that means is that investors are sort of looking at Melbourne as a nice, neat, low volatile sort of environment to start to invest in. We had really strong demand last year. We see strong demand this year because of that. I guess it's a different style of growth to maybe what you're going to experience in some of the other capital cities around Australia and indeed parts of the world. So for that reason, investors are still going to be there for Melbourne, and we're already seeing that in the early part of this year. Okay,
so who are they? Who are going to be the investors, you think? We've seen a lot of interest from foreign investors, obviously, over the last couple of years in Melbourne and nationally. Who do you think the groups will be, the sort of purchasers interested in the market?
Yeah, I mean, things changed a bit last year. Last year was we moved to a 50-50 balance, if you like, between the local investors, particularly the wholesale funds, a little bit of A-REIT activity, and the international investors. There's no doubt that the international investors are starting to find it, in parts at least, a little bit difficult, some of them. The Australian dollars are making it a bit difficult for some of them. And I guess we all have to remember that Australia and Melbourne particularly, we're all competing for that international money, and there are other markets around the world that are pretty attractive at the moment. Nick mentioned Japan earlier. That's certainly one that seems to pop up a lot when we're talking to international investors. Mm-hmm. With respect to the domestic investors, I mean, I think the change was that we haven't really had the stock to test the level of demand for something prime. So we had last year 452 Flinders Street came to the market, really the only prime building that's hit the open market, if you like, to really test that. And the interesting thing about that was when we put that to the market, overwhelmingly it was domestic demand that we saw for that asset, and it was hotly contested because I think, you know, people are looking for that style of asset. So there's money right across the board, both domestic and internationally. There's probably less international money than there was, but I think that's been balanced by an improved level of domestic demand.